Morning. This is Nick Rach with the Earnings Scout, and today I'm going to walk you through how to quickly find some of the best companies in the best industries and sectors based on the sustainable earnings estimate revision trends. First, you need to log into our system, and I want you to go to the Research tab. And under the Research tab, we're going to go to the Screening Drill Down, and we're going to drill down by sector and industry. Now in here, you'll see it's sorted alphabetically, and we have earnings indicator scores, 100 being the best, 1 being the worst, where we relatively rank the sectors that we are most favorable on and least favorable on. And we've been overweight financials for all of 2024 after being underweight last year in the sector. Why? Because they have some of the best revision trends. For the financial sector, it scores a 57. You can actually go in and check out the sector revision trend for financials over the last year. Why do we like it? Because the earnings estimate trends have been progressively getting better over the last year for financials. Now, within the sector here, we can actually view the industries that we like the best as well. And when we click the link for industries, we can see the scoring system that we have for the various industries within the financial sector. When we click on the earnings indicator tab, we can sort and rank the sectors that we like best to worst, not based on our opinion, but based on pure math of the revision trends that we measure on rates of change basis. Now, if we look at the financial exchanges and data industry, one that we want you to overweight within the financial sectors, we can drill down and see the companies. Again, sort by the earnings indicator score, and you'll see a name that we like. A name like FactSet scores 81. Why? Why does it score high, 81? Well, we'll show you. Over the past year, and we default to the 1 year period, but you could look over the last 90 days up to 5 years of the earnings revision trends. Now, here we have a chart that shows the earnings score. This is showing how the rates of change to FactSet earnings expectations are moving across time over the last year. And at the beginning of this year, towards the end of 2023, we saw FactSet's estimates getting cut by a rate of 3.74%. Then in the following earnings season, they were cut by 1.38%. Now they're only getting cut by 0.9% in when they last reported. So yes, estimates are going down, but we don't care if estimates are going up or down. We care if they're getting better or worse. In the case of FactSet, they're getting less bad. What we're showing is the actual earnings expectation trend is improving. We want to buy improving earnings at a cheaper price, and the stock's down 2.9% over the last year. We get solid growth expectations. And on a name like FactSet, when we have stable revisions and solid growth, these are companies that we have that are anchors in our portfolio. And we've had a buy and hold recommendation on FactSet now since it was trading at $92 a share back in 2013. These are core holdings in our model and one that we have in our ES Long portfolio, FactSet. Now, on the flip side, you could see a name we don't like Coinbase Global. It scores a 7. Why? So let's take a look at the revision trends of Coinbase Global. You can see here over the last year, yes, it's improving, but when we take a look at the 2 year chart on Coinbase, you can see the expectations here in 2022 we're getting cut at a 290%. Then you have this improvement. But take a look what's happened here over the last 6 months. And we're going to look at the last 6 months of the data to find out why our model scores it poorly, because the estimate revision trends, while the estimates for Coinbase were going up by 356%, then they were going up by 300%. And keep in mind, the estimates are being raised on a stock, though, that's fallen now 11% over the last 6 months. And stock prices don't follow the change in the earnings estimates. They follow the rate of change to the earnings expectations. And you can see here, this is what's going on for a stock that was up fairly significantly. And rightfully so at first. Over the 2 year trend here, you can see it was moving in line when the earnings estimate expectations are improving. We always want to buy those. The multiple tends to expand. These are stocks we want to buy. But when we start to notice that over uh, the rates of change to their earnings expectations start to weaken, that's when we create a sell discipline to get out of this name. And this is why we start to score this one low versus FactSet, where the earnings estimate trends, when we take a look at that on FactSet, you can see it's up and to the right. We want to buy improving earnings at a cheaper price. Hopefully, you've seen how to do this quickly and that you can screen through every sector and industry. If you have any questions, please get a hold of me. If you have trouble logging in or want to walk through, get a hold of me. We're here to make sure you understand what we're capturing because we want to help save you time, enhance your returns, and eliminate guessing on earnings. Thank you.